I was at Overton one day. I was going down relatively Jon, hi. Good to see you.
Right.
Yeah, very good, thanks. Very good.
Try and sit in there, or should I just take a
Yeah,
seat
we
there?
thought you should probably be reasonably close to here because that's where we'll be speaking.
Okay.
But I think if you're here, you might be a bit confused.
Yeah,
So maybe if you go there,
Yeah.
that should work. I haven't actually done anything in this room yet, so I'm not quite sure how the acoustics and everything will work, but hopefully it'll be okay.
Hi, not actually there. Phil, how are you doing?
It's
Yeah,
me.
good, thanks.
Hi.
Just slide.
Oh great, so that's moved on. Yep. Okay. Yeah. Okay.
Well, we can open up for questions.
Yeah. Don't worry, it doesn't.
Whether I do it, you do it, or whatever.
Just play.
Thanks very much. Thank you.
Looks like they managed to get the camera working.
It's
so ring-a-dink. It's like ridiculous. I've got this massively impressive room. It's funny little camcorder. Do what you can.
Right. Welcome everybody. Good morning. Thank you for coming to our annual property tax update. And I'm very pleased to welcome Jon Fletcher, the Director of Finance and Investment Policy at the British Property Federation, who's come back for another year. Thank you, Jon. I'll be very interested to hear your views. We've got a fairly packed schedule of exciting tax developments to get through. So let's kick off. And the first thing we're going to talk about today is the diverted profits tax, the so-called Google tax, which many of you will be familiar with. This was announced in the autumn statement last December. The context, of course, is the increasing number of very negative headlines that the likes of Google and Amazon and Starbucks have been attracting by using artificial tax structures to avoid paying their fair share of UK corporation tax. I think my favourite of these headlines was actually from a couple of years ago now, and it was when Eric Schmidt, the head of Google, announced his plan to relocate to London and was apparently looking for a property in London for his family in the region of £30 million, which back then still bought you a decent-sized property in London. And the headline in the Daily Mail was, Eric Schmidt could pay more stamp duty than the whole of Google pays in UK corporation tax. So with headlines like that and an election looming, Mr. Osborne clearly felt he needed to do something. So last December he announced the Google tax. It's a tax at 25% on so-called diverted profits. And compared with the UK corporation tax rate, which from next month will be 20%, it's clearly a punitively high rate. He announced that the expectation is that this will bring in revenue of about £300 million, which actually for a new tax isn't a huge amount, which makes you wonder whether this is a vote winner rather than a revenue raiser. Why are we talking about it today at a property tax update? Well, although it's clearly targeted primarily at online businesses and multinationals like Google and Amazon, Starbucks, it's actually been drafted very, very broadly, and it will also apply to the real estate industry and to certain transactions. And I think we'll see this if we have a quick look at the two situations in which this tax is going to apply. Now, I should warn you that the rules are very complicated, and I've only got 15 minutes before my colleagues step in. So this is, by necessity, a pretty high-level overview. The first situation in which the tax will apply is where you've got an offshore company that's trading in the UK. but it avoids having a permanent establishment in the UK by structuring its activities in such a way that its affiliates in the UK are not, their activities will not constitute a permanent establishment. And this is what Google apparently were doing, according to the whistleblower whose revelations contributed to some of those negative headlines. Apparently they have their London team of people who are busy targeting and negotiating new advertisers, but they stop short of actually concluding contracts. And once they get to the stage where they're ready to conclude a contract, they send the contract off to Ireland, and the Google team in Ireland sign the contract. And in that way, they avoid having a PE in the UK. Now, a similar technique is also used in the real estate context by residential property developers. It's fairly common to have a structure that involves the development site held in a Channel Islands company, and then a UK affiliate who helps with the development, but whose activities are quite carefully structured so that they can't conclude contracts on behalf of the Channel Islands entity. The intention here is to take advantage of the double tax treaties we have with the Channel Islands jurisdictions, which have quite a narrow definition of permanent establishment. Now, when the diverted profits tax legislation was first published at the end of last year, it wasn't entirely clear whether this first situation was intended to capture property transactions. And this was largely due to the rather woolly terminology used that was actually more akin to VAT than anything else. It talked about the foreign company making supplies of goods and services to UK customers, which didn't really sort of fit with a typical, property context. However, the rules were amended and republished last week, and it became very clear from the new wording that properties definitely caught. And Jon, I was going to ask you, because I know the BPF were involved during the consultation period, and I think as part of that there was at least a suggestion that real estate transactions should just be excluded from this new tax. I don't know whether you agree with me that that was perhaps an unrealistic expectation.
Well, as you said, the initial legislation was very broadly drafted. The notification requirement in there was also very widely applicable, and we were worried that there was just a general lack of clarity about what was in and what was out. So in our response, we urged the government to give it a little bit of thought and provide some certainty, even though in the end it went in the direction of real estate very definitely being in. I think that's preferable to the situation of us never really knowing whether real estate is in or not, because it would just keep coming up again and again in transactions, and somebody would eventually ask the question, and government would eventually have had to come to a view anyway.
Yeah, no, I think it's right that at least we know where we stand, even if it's not where we wanted to end up. So looking now at the second situation in which the new tax applies. In the first instance, you've got a foreign company trading in the UK. The second situation involves a UK company, so a company that is based in the UK. It does have a taxable presence here, but it reduces its profits by making payments to group companies in low tax jurisdictions, typically royalty payments, interest payments. And the main target of this limb of the new tax is the so-called double Irish structure. Double Irish, I always think, sounds like a really punchy cocktail, but it's actually the name given to the structure commonly used by the likes of Google and Apple. It involves a couple of Irish companies, usually a US entity, and the main intention is to strip out royalty payments from high tax jurisdictions into low tax jurisdictions. However, as with the first limb of the legislation, the second one can also apply in a real estate context. And the context I'm thinking of here is the PropCo-OpCo structure, which many of you will be familiar with. This structure that's typically used for properties that have an operating business attached, so for example hotels, care homes, student accommodation, all common examples. And in this structure, the valuable property interest is held by PropCo, which is an offshore entity, might be Jersey, might be Luxembourg. And the business is operated by way of the grant of a lease to the UK OpCo, which actually runs the business. And the intention, main benefit behind this structure is that on an exit, the appreciation in capital value, which will be realised by PropCo, will be outside the scope of UK tax. Now, looking at this structure in the context of DPT, DPT will apply here if certain conditions are met. The first one of these is the tax mismatch test, and that test will be met if the tax that PropCo pays on the rents payable by OpCo is less than 80% of the tax deduction that OpCo secures by paying the rents. Now, typically PropCo will be debt funded, so that test will almost always be met because the deduction secured by OpCo will exceed the tax that PropCo has to pay under the non-resident landlord scheme on the rents. So that test will almost always be met. The other main test is the insufficient economic substance test, and that one will be met if it's, in the words of the rules, reasonable to assume that the tax benefits of this structure are more significant than the non-tax benefits. Now, with any structure that's had any sort of tax thought given to it, I think that test will almost always be met. So this sort of structure, I think, is likely to be caught, and the revenue guidance that came out yesterday on the DPT actually gives this as an example of something that will be caught by DPT. Now, if it does apply, tax will be payable at 25% on the additional profits that would be realised if the material provision, which is here the lease, was not there and no steps had been taken to mitigate tax. So in effect, I think you're told to ignore the lease and work out what OpCo's tax position would have been if there'd been no lease in place. Now, in this example, I don't think the tax position would actually be very different, because if there was no lease, OpCo would probably have the debt funding, so it would get all the deductions for the interest that PropCo currently gets. So it's not immediately clear that even though DPT applies here, you'd have additional tax to pay. But of course, you've got the uncertainty of not knowing exactly how the revenue would, in effect, recharacterise the transaction to ignore the material provision. A couple of words on process. As with self-assessment, taxpayers have got an obligation to tell the revenue that DPT applies to them. Unlike self-assessment, you also have to tell the revenue if DPT might apply to you, which clearly puts a pretty significant administrative burden on all taxpayers. Everyone's got to sit down and think about whether it might apply. And it's never a comfortable position to be in, to tell the revenue that an anti-avoidance provision might apply to you. The time limits are stacked in the revenue's favour, which is a criticism that a lot of people have raised. The revenue have got 2 years from the end of an accounting period to issue you with a notice saying that they think there's a DPT charge. So they've got 2 years. Companies then got 30 days to respond, which is not a very long time, obviously. And then after that, the revenue's got another 30 days to issue a final notice, actually telling you how much tax to pay. And then the taxpayer has 30 days within which to pay that tax. And only after they've paid the tax can they appeal it. So it's a pay now, argue later tax. So where does that leave us? Well, the tax comes in tomorrow. So the good news is you've got the rest of today to plan around it. But I mean, seriously, with the final legislation only being published this time a week ago, nobody has had very much time to absorb it, work out how it's going to apply and what, if anything, they should be doing in advance of the 1st of April. So I think the prevailing feeling at the moment is confusion as to whether it's going to apply, what the scope is, if it does apply, how to calculate it. There's some fiendishly complicated provisions about how you actually calculate the tax. And looking at it in a wider context, I mean, one thing that occurred to me when we were preparing for this morning is that this time last year, I think one of the things we talked about was the GAR, the General Anti-Abuse Rule. And I did wonder, well, surely that's this, or the double Irish structures, Google and Amazon's artificial tax structuring, surely that's exactly the kind of seemingly abusive arrangement that the GAR should have tackled. And with the GAR and our fairly advanced comprehensive transfer pricing regime, you do wonder whether we needed a whole new tax to deal with this. There's also been a lot of criticism that this new tax is in effect in breach of our double tax treaties. There's a fundamental principle of our double tax treaties that profits realised outside the UK can't be taxed in the UK. The government's response to this is, well, they've got two arguments, one of which I find a bit more convincing than the other. They say, first of all, that double tax treaties are intended to prevent double taxation. They're not intended to assist you in ending up with no taxation, which is fair enough. But they also said that double tax treaties cover income tax and corporation tax. And this is not either of those things. It is a diverted profits tax. But it seems a little bit too easy to get around the treaties by giving your tax a different name. But in any event, I don't think we should hold our breath for a claim for breach of double tax treaties, because I think the only person who could bring a claim like that is actually a party to the treaty. And I suspect that foreign governments, rather than bringing a claim for breach of double tax treaty, they're more likely actually to bring in their own diverted profits tax, particularly if they're looking to either raise revenue or win votes. And so just to round up, I have to say this does all remind me somewhat of something that George Osborne said 5 years ago when he brought in the Office for Tax Simplification. And at that time, what he said was, the previous government took a complex tax system and made it even worse. We need to sort out this mess. Well, regardless of whether he gets in to number 11 again after the election, I think with this new tax, those words may well come back to haunt him. With that, I'll hand over to Nick, who's going to talk to us about CGT.
Thank you, Kirsten. So the first thing I'm going to talk about today is the new capital gains tax, which will apply from tomorrow. So until recently, it was a feature of the UK tax system that capital gains tax was not payable by non-residents. But in recent times, that's been eroded somewhat. So in April 2013, there was the ATED charge for capital gains tax, which is quite unusual and was actually meant to be an SDLT avoidance measure. And then from tomorrow, capital gains tax is going to be extended to non-residents investing in residential property. Now, I guess the concern is this the thin end of the wedge? Is it going to extend to commercial property or other assets? And Jan, I don't know if you want to comment on the BPF's view on that.
Sure, I think you need to remember the context in which this measure was announced. So back in the autumn of 2013, the scenario was rapidly rising house prices in London, a widespread feeling that this was being fueled by investment from overseas and that the government should be doing something about it. So they said, well, at the moment, non-resident investors in residential property here in the UK don't pay any tax. We want to prevent that benefit from accruing to Saudi oil tycoons and Russian oligarchs, and so we're going to impose a tax on them. I think the politics of commercial real estate is very different to that. The fact that we are not particularly interesting from a voter perspective has its upsides and its downsides. This is perhaps one of the upsides in that I'm not sure that there are an awful lot of votes to be gained by extending CGT to commercial property. However, and at the same time, I think government recognise that there is a difference between the two markets. The drivers are different, and therefore it makes sense to have, or you can justify having different sets of rules applying. Even if the government did decide to extend it to commercial property, I think providing that they keep the overall structure and system of reliefs that Nick's going to go through in a moment around widely held institutional type investors benefiting from an exemption to CGT, then I'm not sure that extending it to commercial property would necessarily have such a detrimental impact. And then even for those who are left having to pay capital gains tax, depending on how long you hold property for, it doesn't necessarily, commercial property, it doesn't necessarily appreciate more quickly than inflation. So as long as you're getting some sort of indexation relief, it might be that having to pay some tax on a capital gain doesn't prove to be that painful. So I think in the long run, given that many other countries around the world do levy capital gains tax on non-resident investors in commercial property, and I would argue that it doesn't necessarily affect the attractiveness of their investment market, I think after an initial transition here in the UK, that's likely to be the case. Now, in terms of our involvement in the consultation process, I thought it was quite a good consultation that the government carried out. They were very engaged with a number of different trade associations, listened very closely to some of the suggestions we made, in particular around not wanting to discourage institutional investment in the private rented sector. And I think where we've ended up is a reflection of those discussions.
Thank you. So how is the charge going to work? Well, it's going to apply to capital gains arising from tomorrow. So historic capital gains that are currently in place are not going to be caught. So it won't be retroactive in the way that perhaps the diverted profits tax could be. The charge is going to apply not just to individuals holding residential property, but also vehicles through which individuals could invest. So trusts, companies, certain types of funds and partnerships, although I'll go on to talk a bit in a moment about some of the exemptions that will apply. The rates are going to be 18 or 28% for individuals, depending on their personal tax position, 28% for trustees and 20% for companies. Now the rate for companies reflects the corporation tax rate from tomorrow's, and I assume it's there to ensure that these rules aren't in breach of European law, but it seems obvious to me that there's a clear arbitrage there between holding directly and holding through a company of about 8%. The final thing worth mentioning in the round is what is residential property for the purpose of these rules. Well, I think the starting point is that a dwelling is residential property, but there are a number of important exemptions. The most important of the two I put up on the slide there. So purpose-built student accommodation is not residential for these purposes, and that was something that the BPF and other parties lobbied for hard. And also residential care homes won't be residential accommodation for these purposes. There are some other more unusual ones in the list, including the one I like, which is a prison, apparently isn't residential accommodation for these purposes. Now, as Jon alluded to, when the rules were first published, there was a real concern about how they might affect the PRS sector, and in particular institutions investing into that sector. The government had started from a rather naive point of view that institutions would hold property directly, and therefore if they had an exemption for institutions that would be fine, or if they joint ventured it would be through a partnership. But through the lobbying that was done by some parties, including the BPF, they now accept that institutions would want to invest through a company. And so included in the exemptions that are going to apply to this tax, there'll be an exemption for a company that's diversely held, and I'll talk about what that means in a second, and then also exemptions for fund vehicles that have genuine diversity of ownership. So that's what the unit trust scheme that's widely marketed and the OIC that's widely marketed is getting at. And widely marketed for these purposes means pretty much what it says on the tin, that it is widely marketed. I think one interesting point where there's a bit of uncertainty, and it'll be interesting to see what the guidance says, if anything, on this, is the position of a Channel Islands unit trust. So a Jersey unit trust, for example, is a deemed company under corporation tax rules, but equally there are these specific rules around the treatment of unit trust, and it's uncertain at the moment where that falls. Hopefully it's a company, and then it's pretty easy to see how the rules will apply to it. So if you're holding residential property through a company and you have some people behind it that aren't individuals, I think it becomes pretty important to determine whether or not that's closely held. So what the rules allow you to do is they effectively allow you to trace through the arrangements to see if there is institutions or individuals who are the ultimate beneficial owners of the structure. And if it's the case that you get to a situation where the ultimate beneficial owners are broadly more than 50% institutions, these charges shouldn't apply. But if you get to individuals, then the rules can apply. Now, what are institutions for these purposes? It was hoped that there would be quite a long list of institutions, a bit like there are for the REIT rules, but actually it's much shorter and includes just the 4 things up here. But hopefully, because it mentions pension funds, for example, it should be getting a lot of the PRS sector. And then also there was some lobbying for life assurance companies to be included in the list, and they are as well. There is some, I don't propose to go into it because it can be quite complicated, but there is some rules in there which allow you to effectively have an offshore group and to pool the arrangements within that group. And the idea there is that losses from one part of the group could be applied against gains from another part of the group. You make an election, the election is for all times, but I think I would caution against people just rushing out and making the election, because it has other knock-on effects in terms of degrouping charges if you sell a company from that group, which wouldn't otherwise be caught for the tax. So just some very basic examples here. In the first picture, we've got a property owned by an SPV, which is in turn owned by an institution. The rules allow you to look in the first instance at the SPV. That would appear to be closely held, but when you look through to the institution behind it, you have an exemption, which means that if the property was sold, then the charge wouldn't apply. In the second example, you have the ability to effectively trace up through the structure, and at the top we have institutions owning everything. Therefore, if the property was sold, there wouldn't be a charge to CGT. And in the final example, I'm just trying to show that by tracing up through the structure, if we hit individuals effectively controlling or owning more than 50% of the underlying property interest, if the property was sold, there would be a charge under these new rules. Now, I think one of the unknowns is how these are going to apply in terms of sales of the SPVs that own the properties themselves. So at the moment, the charge only applies to the sale of the property interest by the non-resident SPV. There are a number of examples of where there could be deemed disposals and also some anti-avoidance rules. But as a starting point, if you sell the SPV, you don't appear to be caught for the tax. So that just raises question marks as to whether or not people are going to buy and sell offshore SPVs instead of the properties themselves, and whether that might be factored in to the price, or whether, for example, an institution buying might be happy to swallow what appears to be a latent gain because they won't ever suffer that particular tax. So I think these are sorts of issues that are going to be thought about a bit more as people come to buy and sell these vehicles in the future, and there's a commercial negotiation around the point. The next thing I just wanted to mention very briefly is ATED, the annual tax on envelope dwellings. So when this was originally introduced, it applied to high value residential property of more than £2 million. From tomorrow that drops to £1 million, and from next April down to £500,000. And this is property that is owned in an envelope of a company. Now, for people in this room, the charge or the charge shouldn't apply, because there are a number of exemptions for, among other things, property investment, property development and property trading activities. However, you have to claim that exemption, and if you don't claim the exemption, there's a possibility of the revenue levying a penalty on you. And my understanding is that they've been quite happy to levy penalties on people that haven't filed the returns. Now, because the charge is going to apply to a much broader range of properties than was previously the case, there's been some thinking about how people might be able to claim the exemption more easily. And so until October this year, there'll be the ability to put in a form to say that I get the benefit of the following exemption, and it's one form per exemption. And I haven't seen this form, although I've looked online. Some of my colleagues in the industry seem to have got a copy somehow. But apparently you make a claim per exemption you're going to apply, but not in relation to the property itself. So I think that causes a bit of an issue on the due diligence side if you're buying, because how do you marry up that there's been a proper claim for exemption applied to that property? But we'll see how that develops when people again buy and sell these companies in the future. And finally, I also wanted to mention the Skies management fee. This is not in the context of the property industry specifically, but from the autumn statement last year, there was a rather innocuous announcement about how certain types of partnership arrangements where local management were getting benefits was going to be caught and taxed as income. I think that when the rules were actually published, the concern was that the definition of what disguised management fee was very, very wide, and then there were exemptions for carried interest and co-investment, but they were narrowly defined. And so there was quite a bit of lobbying, especially by the BBCA, yes, to get those exemptions broadened and maybe a little bit more user-friendly. And I think they were successful in achieving that. The definition of carried interest, for example, previously assumed that you made your carried interest on a realised basis, you had a performance hurdle of 6%, whereas that definition is now a safe harbour and is more of a wide-ranging, and is this a performance-related profit type approach. So I think that now there's some much more user-friendly definitions there, but if it's the case that you are a local management being incentivised through something other than a co-investment or a carried interest, it is probably going to be income under these rules going forward. And with that, I will hand over to Phil, who's going to talk about the small topic of BEPS.
Thanks, Nick. On the plus side, I'm not telling you about something that's coming in tomorrow. 2 things out of 3 is probably enough for you to work through in the next 24 hours. The BEPS project, for those that haven't heard of it, refers to base erosion profit shifting. It's an international project by the OECD looking at trying to come up with some form of consistency in the treatment of corporate income tax throughout the world, with an aim of stopping companies divert their profits into low tax jurisdictions, a topic very, very clearly discussed earlier. The BEPS project is huge. There are 15 different action areas that are looking at. Simply don't have time to cover all of them. So for this, thought would focus on specifically action point 4, which looks at interest deductions, which is obviously quite a key area in the property industry, getting a deduction for interest against taxable income. Many countries already have significant rules dealing with interest deductibility, and the OECD have looked at a number of these, but the focus of this discussion draft that they've published is looking at 3 specific types of rules that they might want to try and implement, and they are fixed ratio rules, group-wide rules, and targeted rules. What I should say is that this project is an aim to get a best practice. It's looking at the perfect world and advising countries on how they might want to apply these rules. This consultation is its recommendations at this stage. It's looking at what might be introduced. So what I'm going through here is not something that is coming in this form. It is potentially going to come in one of these types of forms. The document itself covers many different options, so I'm not going to go through all of them, but probably just focus on where they seem to be leaning at this stage. One of the original views that they've taken is that they need to focus on the levels of interest rather than the levels of debt. The base erosion is looking at reducing your taxable profits with interest deductions, so they feel it's far more appropriate to look at whether the level of interest is at the correct level rather than whether the level of debt is the correct amount. A lot of countries at the moment have thin capitalisation rules, which just very basically look at what is the level of debt against the level of equity in a company. But that's not a very accurate way of reflecting whether there is too much interest deductions in those companies. They slightly strangely seem to be leaning towards having no small exemptions, which would make quite a big compliance cost for all businesses. For example, the UK, for transfer pricing rules, there are exemptions for small and medium-sized enterprises, and you would have expected a similar thing to be recommended here. The OECD seem to be leaning towards suggesting that shouldn't be included, but they do acknowledge individual countries may want to apply their own de minimis thresholds. So the two main rules they've looked at are group-wide rules and fixed ratio rules. The group-wide rules seem to have the most support from a kind of academic viewpoint. The aim of them is to look at how much net external debt a group has as a whole, and then allocate that debt amongst each of the group companies. So what it's trying to do is restrict company groups putting lots of intergroup debt in place to increase tax deductions where the company receiving that debt is not necessarily taxed on the income. And what this is doing is realigning it to the group's actual external banking costs, which in practice sounds like a good way of doing that. There are, however, obviously lots of quite complicated ways of looking at that. How do you allocate interest amongst group companies? What they're potentially looking at is you look at the earnings in each group company and allocate the total net expense, net interest expense amongst those groups. But looking at a worldwide international group, different countries have different calculations of earnings. They have different accounting rules, they have different tax rules, and the compliance burden of having to look at every single jurisdiction and potentially not allocating earnings consistently makes that very difficult to apply in practice. You also will have certain groups that don't make any profits at this stage. You might have developments where they're not income producing for the first couple of years, and in the future they are. Those companies would be disallowed interest expenses for the years in which they're not making any profits, which doesn't seem to fit quite right. So they are very attractive in principle, but they will probably be very difficult to apply in practice, and that is, I think, acknowledged by the OECD in the paper. A far more straightforward rule that could apply are fixed ratio rules, and a number of countries already have these, and really all they do is they restrict the amount of interest that specific companies can apply, so it's done on a company by company basis rather than looking at the group as a whole. And it takes a benchmark ratio and calculates that against earnings and restricts your interest deductions to that amount. So for example, countries like Germany, Spain, Italy already have this rule where interest deductions are restricted to 30% of EBITDA. So it's a far more straightforward rule to apply. The concerns the OECD have is whether this will actually have the effect of reducing base erosion. They quote a survey done by PwC in 2013, which looked at the net interest expenses of companies in the global 100 list. And the conclusions they reached was that the interest expense was only, for 75% of those companies, the interest expense was less than 10% of EBITDA. Whereas countries, as I said, like Spain and Germany have a 30% rate, a 30% limitation. So really there seems to be a lot of headroom there that won't work to reduce base erosion. The slight difficulty with the OECD using surveys that are done now is interest rates are obviously at an all-time low, so not surprisingly, interest expenses are not as high as they have been in the past. So where do you set that benchmark percentage? You have lots of different jurisdictions which have different interest rates, currency fluctuations. You have sectors in each country which have very different borrowing needs. You have seen sectors like the property industry which have very capital intensive and therefore borrowing is much higher. And setting a single benchmark that applies across all sectors seems a very difficult approach to take, whereas setting a benchmark for individual sectors and having different rates that you can and can't apply will then add difficulty as to which sector do you actually fall in. How can you say whether you are property investor or some other industry. So potentially what they might look at is some kind of combined approach of the two. And they've suggested a couple of different approaches. You might have a general rule which has a group-wide interest allocation rule, and that is the standard that all businesses have to apply. But they might have a carve-out for those groups that are very low risk of base erosion because they meet a very low fixed ratio test. And that way you can reduce the compliance burden for some entities. As I say, these are all recommendations, and they are at the moment just looking at what the options are. To help with those general rules, they're also looking at whether there might be some specific targeted rules. They're concerned with connected and related party transactions. And the idea was these targeted rules may help support the general rule. I think the OECD are in the lookout for any suggestions as to what these targeted rules might be. They haven't necessarily got ideas as to what specifically they should be. As I mentioned earlier as well, you may have entities that are not currently making a profit and therefore are disallowed interest expenses. They suggest that it should be equitable, that they can carry forward some interest expenses, so set off against future taxable years, but consider that having that indefinitely would probably counter the benefit that they're trying to achieve. So there may be some kind of limit on the amount of years that you can carry those losses forward. And finally, they do appreciate that for something like the financial sector, these rules just simply wouldn't work, and they have to come up with a new set of rules targeting that specific sector. And then the question is whether there are any other sectors where there should be targeted rules as well, not just the financial sector, which is probably a good point to pass over to Jon. The BPF submitted response to this consultation. He can talk through some of the issues that relate specifically to the property industry.
Sure. So I mentioned earlier some of the potential upsides of not being very politically interesting. The downsides is that policymakers generally know very little about commercial real estate, about real estate investment, and in fact, as has become evident over the course of the BEPS project, they know very little about investment structures generally, because a lot of their proposals are very clearly targeted at widget manufacturers, big manufacturing groups that operate across borders, that obviously have very different business models to an investment structure that is there purely to hold assets and return profits to investors. And there are very different tax considerations there. So one of the struggles we've had is getting them to understand that in an investment fund context, tax transparency is absolutely critical. If there is tax drag on the way up from the underlying assets to the ultimate investors, you reduce the viability of investment, and that's true for private equity as it's true for real estate, as it's true for infrastructure or whatever. I think the OECD are, broadly speaking, comfortable with investment funds that deal in equities and bonds and other listed securities, but the more alternative type of assets like our own is something that they really struggle with. I think another problem is that they very much see that, or their approach during this consultation has been very much to think of debt primarily as an instrument to avoid tax or to shift profits between high tax jurisdictions and low tax jurisdictions. And there's very little acknowledgement of the fact that debt plays a critical and very useful role in financing projects, not only for equity constrained people, so where you might not be able to entirely equity fund a project, but also because it gives you flexibility, it gives you certainty about the payments you're going to be making. Also, in certain countries, it's quite difficult to repatriate profits by way of equity because there are limits on the amount of distributions that you can make. And so having intragroup debt allows you that flexibility of being able to repatriate profits on a basis that's perhaps more in accordance with what your investors would expect from you. So I think the real danger here is that we end up with rules that don't recognise that different sectors use capital in different ways, and that very capital-intensive industries in particular are more structurally reliant on debt. Given that the overwhelming policy objective at the moment everywhere seems to be to encourage economic growth, it strikes us as a little bit odd that they are potentially doing something that increases the cost of capital for productive real estate development and investment, exactly at the time when you would have thought that that's the kind of activity you want to encourage. However, this has all been very politically driven. It's been the G20 that's mandated the OECD with coming up with these 15 action points, and I think as we're going to go on to see, will anything actually come from this? My view is what politics can make, politics can probably unmake as well. So back to you. What's happening next?
Yes, will anything change? I personally am a cynic of the BEPS action plan. It seems a great idea in practice to reduce tax avoidance and make every jurisdiction get its fair share of tax relating to the economic activities of the entities in that jurisdiction. However, it's hard enough for two countries to agree a double tax treaty between themselves. Coming up with a set of rules across 15 action points that the entire international community will agree with and want to implement seems to me quite fanciful. The OECD's view is that a set of rules will be agreed. From this consultation, they will come up with a recommendation. The consultation closed in February, but they're not due to feedback, I think, until towards the end of the year, so there's unlikely to be much more movement on this until later in the year. But they are recommendations of best practice. They're not, they can't force all jurisdictions to bring in these rules, and they can't force all jurisdictions to bring them in consistently. And as soon as you lose consistency between the international world, it kind of defeats the purpose of it in the first place. From the UK's perspective, I don't believe the UK was particularly concerned about this action point and interest deductibility. The revenue are far more sophisticated in their transfer pricing capabilities than some other jurisdictions. And I think generally feel that transfer pricing is a sufficient tool for limiting excessive interest deductibility in this country, and therefore don't specifically feel that new rules are needed. We also have the quite complicated worldwide debt cap, which further restricts interest deductibility for UK corporation tax. I mentioned briefly the 2012 consultation. This was an announcement in the budget in 2012 that they were going to look to into the potentially changing the taxation of interest income in the UK. There was a lot of fear at the time that this was going to restrict deductibility generally. As it turned out, it only focused on withholding tax. And as it then turned out on top of that, very little actually changed. So I think the UK, having looked at interest deductibility quite a bit in the past, may not be so keen to bring in more complicated rules. So it is something definitely to keep an eye on, and any restrictions on the availability for interest deductions, as Jon said, is quite key in the property industry. But whether or not anything actually comes out of this, I don't know. The final thing we wanted to cover today, which we will do so very quickly, and moving completely away from BEPS, it wouldn't be a property tax update without something about SDLT, albeit there's not huge amounts to say on this. You'll have all seen in the press that the residential rates have changed from a slab system up to now slices to make it far more fair. So if you're paying less than £937,000 for your property, you save SDLT. For most of you, probably in the business context, this is less relevant because you have to remember that if you buy 6 or more dwellings together, they're treated as commercial property, and things like student halls or residents are also viewed as commercial property, though this is subject to multiple dwellings relief where you buy, where you can potentially save some SDLT based on these new rules. Don't know whether they're likely to impact at all on commercial property, the changes?
Well, certainly not for the time being, but interestingly enough, there was a fair amount of parliamentary debate after the changes to the SDL2 rules for resi. The opposition in particular asking why haven't you also changed them for commercial property? And well, the reason I would say is that the dynamics are totally different, and the cliff edge distortions that you were getting in residential property market are far less relevant in the commercial property market. But the Treasury did actually cost up how much money it would bring in if the regime that now applies to residential property were to apply exactly as it does to commercial property. And they reckon it would bring in an additional £3.2 billion, which is a lot of nurses. So I think it was remarkably restrained of the government actually to I think in the words of David Gork, he's quite a deadpan guy, he said, I doubt that business would find that very welcome. So, I mean, I think it comes back to government recognising that there is a difference between the commercial and residential property markets, but whether a future government would see it that way, I don't know.
Coming back to the theme of something coming in tomorrow, Scottish Land and Buildings Transaction Tax comes in tomorrow. It's the Scottish equivalent of SDLT. So now there are going to be two regimes running side by side for properties in Scotland. You should be aware that just because it's property in Scotland doesn't mean SDLT is completely irrelevant now, to the extent there are any properties where there are future amendments to the original SDLT to be paid, such as where there was a lease based on uncertain rent where reasonable estimates were made. That still requires a further SDLT payment to be made rather than an LBTT payment to be made. The regimes are similar but not identical, so it's just an extra compliance burden, another tax to be aware of. And there's now also talk of a Welsh LTT. This will come in, but not until 2018. So that will be then 3 different taxes to run, all probably slightly different. And an interesting point that was mentioned the other day was, at least on Scottish property, you will have Scottish lawyers dealing with that from a property perspective. You won't have the same for Welsh property. So you'll need to find some Welsh advisors who will just advise on LBTT. And the final point is ceding relief for PAFs and COACs. This was also, I think, mentioned in the property tax briefing last year, or probably be mentioned in the property tax briefing next year. It's an ongoing saga. Nothing is going to change before the Finance Bill 2016. There are ongoing negotiations probably between the industry, who want a workable set of rules, and the Treasury, who are, having been stung by 64A unit trust ceding relief in the past, are quite nervous about amending the rules at all, with the potential for tax avoidance going forward. So it's ongoing. There's nothing further forward here to really report, and it's watch this space. So that's quite a whirlwind tour of a number of different areas of updates. We clearly didn't pause for any questions as we went through, because there was a lot to cover. But if anyone does have questions now on any of the topics, we are welcome to take questions now on the floor, or we will be hanging around afterwards if people wanted to speak to us individually on anything. But if anyone has any questions. No? Oh, yeah.
Can I ask a slightly different question? General view seems to be there are going to be tax increases after the election wins. Both parties seem to be ruling out the main suspects like income tax and VAT. Are there any areas that you're worried might change that would affect the property industry after the election?
Well, I think something that's already been mooted, albeit not necessarily in the increased direction, but is a review of the business rate system. That's clearly a very property-specific tax, and the focus from the industry has been very much this is too high a burden for businesses to bear, and we need to find some more equitable way of dealing with it. I'm not sure that there will be appetite among government or a future government to increase the overall burden of business rates, given how much media attention it's received. But I take your point. It's hard to see where those tax increases are going to come from, and I mentioned SDLT. I personally have been a little bit surprised that, I mean, how long has it been since the commercial rates last went up? 10 years? Longer? I don't know. It's been quite a while since they increased the rate of commercial property SDLT, and you know, they might just take a look out of the window and see, wow, that's a lot of cranes. You know, there's clearly something good going on in the commercial property sector. I'd quite like a slice of that. I mean, it is something that we worry about. Have you got any thoughts?
SDLT, as you were saying, seems like a candidate.
Diversity profits tax. Situation with an avoided PE, as you said, is very common in the resi development sector in London. I know a number of businesses and entities that are structured in that way. Do we have any thoughts as to what they should be doing?
Well, I think what they yes, once they've got over the panicking stage, they probably do need to do something, and whether that's moving the properties onshore, or perhaps migrating or immigrating the Jersey or Guernsey entity into the UK, something like that, I think will probably be needed to avoid the 25% charge. And of course it's not ideal, because the structures are set up with the intention of paying 0% tax, and you're now sort of fighting to ensure that you're only paying 20% tax. But I do think these structures will need to be looked at and actions taken. And of course, as part of that, you can look at increasing the cost as much as possible, so putting in debt finance where you can. One benefit of transferring the properties is that you sort of bank any increase in value that's already accrued. But I think sort of turning a blind eye and hoping it's all going to go away is sadly, after last week, no longer an option.
Okay, well, thank you all for coming along. I hope it was interesting and helpful for you. If you have any other questions, we will be around if you want to speak to us, but otherwise, thank you for coming.
This is right question just came up as a matter of course. So, perfectly dovetailed. No.
Yeah, it's filming in a topple over.
Yeah, well, these are some of the roof panels.
Yeah,
I bet your boat was quite
she's great.
Apparently it's freezing on top of the star
So if you have calls along those lines, so DPT are going to
yeah. And I think, I mean, originally I think the hope was that there'd be something cargo.
Yeah.
But of course, they would actually say to the revenue corporates they're trying to capture these Jersey schemes. You know, even if they hadn't been intending to, as soon as it was brought to their attention, I'm sure they thought, oh, brilliant. So it is, and I think that the problem is that if people wait until next week, and then they can sort of do clever things with short accounting periods, you've still got a part of the profit will be within the tax. Certainly when it comes to me, I'll be kept busy wanting to move things.
And it's development, so you can't even.
The problem with the development though is that the retroactive nature.
Yeah, and that's why I think that you're better off moving things.
Yeah.
Because at least then you get a step up in your costs.
Yeah.
And also it's very clear cut to which you moved offshore. My concern is just changing the board, so that it's always exactly when it stopped being Jersey.
This came up in the text about worrying about whether or not you could get this to I think the feeling was that you probably could.
Yeah, I mean, I think
be a bit unfortunate.
If you're
Avoiding
avoiding an anti-avoidance tax,
But it's not any tax that's
by
listed because it's not
coming to
corporation
Ah,
tax, it's not
that's
income
true.
tax.
Yeah, that's a good point. That's a very good point.
Beautiful. Because that's what they want.
exactly, they're doing what they want to do. Yeah. Anyway, I'm going to see.
You didn't say what flavour wine you like.
Oh,
So you're
I'm
just
happy
going to
with
get
the
whatever.
mix. I'm happy with that.
So you're getting blue nut.
Blue nut.
How long have you guys been here now?
Since September. No, since October. End of September. And the last week in September was the first shift. June because I was on holiday, so I sort of turned up and it was done. Some of those in summer or certain shades of but being gone for the shades everyone's like it's ridiculous.
I can't produce that.
Yeah, right. Yeah. YouTube clip with the guy watching Welsh. Oh, you did, yeah. Camera with his pelvis, and he's going fast, goes back, and you sort of see these sort of sheep in the field, and the sheep sort of go around, and suddenly there's a mighty the sheep just looks across the camera, and they're like, work out. I don't know if that
seem to know then what because they couldn't see us.
Yeah.
But they're clearly some people don't know what cost their business do.
It's the thing we're talking about by acquisition for what it means for funding structures in values. They can do everything from rent collection right through to distribution. So for now got
They need to market themselves more appropriately. They should take some ideas from that forward to the best market. They do very much more into business, but Capita.
would you
They need to market to the right people.
marketing it, they will do that themselves, but actually doing that.
Or
So
have they done it themselves?
no, just say, but now we've got the
Yeah, because we always get asked to recommend. Oh yeah, they've been managing the business. They don't. Yeah, that's interesting. Yeah. But I didn't know that they did all this.
On real estate, so probably other things as well. So it's not really
But probably the people is must
I don't know what's difficult stuff to do.
the most difficult is getting people have to be remunerated pay as the business wasn't. But it's good for us to know what people do because our clients like us because we know what's going on. And that's like what it is. We're not a supplier to them, but they do recommend us to. But it's more sort of because we
Exactly.
and there's so much every time we do jobs stuff structures. How much time is that taking up? Well, I think we've got women's rights are very heavily stuck. That's correct. Otherwise, the investors just looking after their own. And quite often, it's not within their remit. But yeah, I mean, there's invested advisory is big investors who know what they're doing. And also, when you talk about the largest foreign investment, normally they will be a sizable chunk. Whereas if you're a lot of people with 2, 3, 4. That's what it was like when I started in this game. It was not a sort of private equity, it was 5 or 6 or 7 investors.
Sorry?
Okay, well, at least that we know now. Still, in record, this morning he came in with another member sending to you, right? And it started recording. Now will be the moment of truth. Did it record? Can we play it? I didn't know it comes up like that.
But on the main screen, it just shows
yeah.
the slides.
It's
yeah.
still recording.
Not too bad. Good.
We stop it. Yeah.
Is that the first time you've come
Yeah.
here?
Yeah.
I've been at 84, so I wondering where you
Make a house. All right.